I'm Rick Kaler. Thanks for joining me. Well, dying isn't getting any easier. The federal estate tax rules changed radically this year in 2010 and could change radically again in 2011 unless Congress passes new laws in the lame duck session after the midterm elections. In 2001, Congress passed legislation which provided for lower tax rates and significant phased-in increases in the federal estate gift and generation skipping taxes. Now, as a result, in 2009, the estate exemption increased to $3.5 million per decedent, with a flat tax of 45% on any excess. Now, that's pretty simple. But in 2010, the federal estate tax was completely repealed. The step-up in basis rules, and these are the rules which give a fresh start, fair market basis, meaning all the assets are raised up to the price as of the market value as of the date of death for most of the assets, was replaced with an adjusted carryover basis. Now, these new basis rules permit a step-up in basis of up to $1.3 million, plus an additional $3 million for certain spousal transfers at death. Not so simple. On January 1st, 2011, the estate tax reverts to the 2001 laws with an exemption of only $1 million and a tax rate up to 60%. Now, every estate planner I knew expected Congress to carry the 2009 estate tax rules with the $3.5 million cap, 45% cap on taxes, expected those to be carried into 2010. In December, the House unexpectedly failed to act on a one-year extension and instead sent the Senate a tax bill to make the 2009 rules permanent. Because the Senate was forced on health care and there was no broad disagreement in the Senate on what to do with estate taxes, Congress enacted no changes to the 2010 rules. So, as of January 1st, 2010, there is no federal estate tax. It's very possible that Congress may do nothing in 2010 and let the estate tax revert to the 2001 levels, the 1st of January 2011. It's also possible that after the November elections, Congress will pass legislation retroactively extending the 2009 exemption and those tax rates to 2010. While doing this would be almost unimaginable and raise the current chaos to levels never seen before, I wouldn't rule out such a move by the current Congress. There is broad disagreement on whether a retroactive tax bill is constitutional. If a retroactive tax law is adopted, it will be challenged as unconstitutional, and it could take years for the Supreme Court to rule on the issue. The more desirable step would be for Congress to extend the 2009 exemption for 1 year and let the new Congress hash out what to do going forward. Unless new legislation is passed after the November election, then on January 1st, 2011, a number of automatic changes occur to the federal tax code. The estate tax exemption drops to $1 million, and the estate tax increases to 55% above $3 million and 60% above $10 million. This means the heirs of a person with an estate of $3.5 million who died in 2009 would have paid nothing. If that person should die in 2011, the tax bill would be around $1 million. The only good news here is that the fair market value step-up in basis is also reinstated. Congress's failure to adopt estate tax legislation in 2009, plus the possibility that changes will not be adopted during 2010, drastically affects estate planning for many people. Some possibilities might include reconsidering whether you need life insurance to help cover estate taxes, giving more to children or charities now instead of through your will, or taking as much earned and capital gains income as possible in 2010. The challenge is to plan for estate and income tax laws that may or may not be enacted. Pretty tough. This uncertainty makes it more important than ever that you work closely with a knowledgeable accountant, financial planner, and estate attorney. Thanks for listening.